I want to welcome the great Andy Schectman back to the show to give us his perspective on what is happening in world markets. Welcome back.
Good to see you, Elliot. Thanks for having me, buddy.
Absolutely. Always great to talk to you. To me, the biggest story as we're sitting here, I'm seeing the SILJ Junior Silver Mining ETF up 7%. I'm seeing the SPY down 0.29%. I'm seeing gold up 1%. Oil obviously up. All these things totally outperforming stocks, especially growth and tech stocks, which are crashing among these yields. So doesn't that seem exactly like what happened in the 1970s with Jimmy Carter? And so is this the perfect storm for gold and commodity investors all of a sudden?
There's no question but that it's the perfect storm. You have an environment where if interest rates continue to rise, you will look at a decimation of the stock market, the real estate market, and ultimately the bond market, a collapse, all three of them. It used to be that these were inversely correlated markets. Stocks and bonds had an inverse relationship, and they don't any longer. They're both inversely correlated to a rise in interest rates, but positively correlated to one another. And so, when I started in this industry, in 1990, you had interest rates at 9%. And so a $2 million investment in 10-year treasuries netted you $180,000 a year in tax-free income, never touching your principal. You'd need 20 million to do that same thing right now. And as a result of these ultra low interest rates, where you've seen an inflation in stock prices to all-time highs and all-time valuations on top of all-time highs in the bond market, after a 25-year run from interest rates, up in the 9% area when I started in this industry down to where they are now, basically negative. That's a big, huge gain for people who were in the bond market. So what happens is you have both of these markets at all-time highs, and if interest rate and throw the real estate market square on top of that as lighter fluid and kindling, and when interest rates rise, poof, they all find real price discovery. What is $1 million home worth at 3% jumbo mortgage versus 6 or 8 or 9%? When I bought my first house in 1994, interest rates were 8 7/8. So what is $1 million home worth at 8 7/8 versus 3? That's 3 times the cost of carry. So, if it costs you $3,500 a month on $1 million mortgage at 3%, it costs you almost $10,000 a month at 8.8 7/8 or 9%. Doesn't work. The whole thing collapses, tries to find equilibrium, and as rates rise, these assets that's the real inflation, Elliot. The real inflation is in asset prices, and they have to find their equilibrium. And the only way they do that is by letting interest rates find their equilibrium, not being controlled by politicians and bankers. So is it the perfect storm? Hell yes, it is. And when you talk about, why in 1980 rising interest rates killed gold, there's a term in economics called Gibson's paradox, which cites the inverse relationship between real interest rates being the term here, not nominal, and the price of gold. And so when we talk about Gibson's paradox and people say, well, rising rates will hurt gold. No, they won't, because the real rate of return at a 2% interest rate level with 7% inflation and rising is still -5, which beats the hell out of, a no return, no coupon yield on gold beats the hell out of -5%. So I think that you'd have to see rates rise above the level of inflation to stop inflation and to stop the gold market ultimately. And I think what people are missing is that when you see some event where the markets start to crumble and the institutional money looks for a place to go, I guarantee you they will notice gold and silver. Not only are they undervalued in comparison to all asset classes being at all-time highs, Econ 101, which talks about, you would think, just looking at Econ 101, that gold and silver should be much higher right now with massive money creation and inflation, but they don't talk about COMEX manipulation in Econ 101. And so before this is all said and done, the 8 banks like Bank of America, who is short 800 million ounces of silver right now, 800 million they're short. So with silver up, what is silver up today? $1 almost? Silver's up 50 cents. They've lost $400 million so far today. So
Wow.
When you talk about how quickly they could be wiped out like that, just like Bear Stearns did when JP Morgan inherited their short position in 2008, wiped them out when silver went from 9 to 21. Anyways, the bottom line is that, is it the perfect storm? Absolutely it is. And especially when you talk about the massive amount of short covering that could very quickly push this to stratospheric proportions that people aren't ready for. And I don't know how far away we are from that, but I will tell you that in my mind, there isn't a better value on the planet than silver right now when you take all of this into the equation, not to mention the absurdity of our current administration and the path that they're leading us down, and all governments around the world. One other thing I'd like to talk about, I know you didn't ask me, it's a complete right-hand turn, but you had 11 nations from around the world the other day. I think we may have talked about this last week. I'm not sure if we did, but anyways, talking about, and Jay Powell was asked, what's the greatest threat to the U.S. stock or to the U.S. economy? And he said a cyber attack. At the same time, you have 11 countries from around the world, along with the same group that simulated viruses in 2019, the World Bank, the IMF, the BIS, Klaus Schwab and his group. They all got together and simulated a global cyber attack and the ramifications on the financial industry. And I don't know, it's a little frightening to think how fragile this whole thing is if an EMP went off and the whole thing just went poof. And now what? What do you have? Where is your liquidity? How do you transact business? So I don't know. I think in the environment that we are in, the things that we see in the periphery, the economics we see here at home, and the politics and the geopolitics make anyone who's not having at least a portion of their assets in precious metals for their wealth capacity, not their investment capacity, but you may make a lot of money in silver, you probably will, but that's not why I own it, it's wealth. And I think that's what people need to do right now. I think it's very important, Elliot, and honestly, I truly do.
Big headline I want to go through. Global bonds under siege as Treasury sell-off spreads. What is your take on rising bond yields?
It is the market's reaction to the Fed claiming that they're going to get tough on inflation. I don't. The Fed says that they plan to raise rates possibly by 2%, to 2% by 2022. But as Peter Schiff said, that's spitting in the ocean. It really is, because how do you fight inflation that's running at 7% with 2% yields? So, off air, you asked me about 1980 and how did that, if that was the perfect storm, how did they stop inflation and kill the gold bull market? Well, in 1980, Paul Volcker raised interest rates to 20%. And when you have the greatest mountain of debt that has been created in the history of mankind at the lowest interest rates in human history, if you even attempt to raise interest rates to that level, the entire thing just absolutely implodes. Stocks, bonds, and real estate. Those are the three pillars of wealth in the United States. And so, the bottom line is that in speaking just, I think, flat out honestly, the Fed can say all they want, they're jawboning. Let me give you an example. They said that they were going to start to taper and take 15 billion off of their 130 billion in asset purchases every month in December. When we look at the actual numbers, it was only 5 billion. So yes, they did taper, but a third of what they said they were going to. Everything the Fed tells us, just about everything, you could bet the opposite. Go all the way back to Bernanke telling us the subprime crisis was contained, only to find it a few weeks later blow up. You had Janet Yellen and also Jay Powell telling us that inflation was transitory, only to find out indeed that was a bunch of crap and it's structural. You have them telling us that they want to pare down their balance sheet on top of raising rates and stopping asset purchases altogether by March. It's this rhetoric, and that's all it is jawboning, in my opinion, that is making the knee-jerk reaction, if you will, on the Treasury. I'm surprised that the 10-year Treasury is acting the way that it is. I would be shocked if the 30-year does, because the bond traders are smarter than the politicians' rhetoric. They know that if they raise rates substantially enough to combat inflation, look, if you have inflation at 7%, and let's remember that the way that they calculate inflation, Elliot, the CPI was massaged and changed so much since 1980 to fit an inflationary policy, if you will. If we just look at the way the numbers were in 1980, the way that the CPI gauged inflation, measured it before they changed the metrics, you're at 13.5% inflation right now, according to Shadow Stats. And all they do, John Williams at Shadow Stats, is measure inflation the way it used to be measured prior to the 1980 revisions. So the bottom line is, when you exclude food, energy, and housing, 7% inflation is easier to come to than when you really add into it the assets that are really inflated. So the bottom line is, even if we believe the 7% inflation rhetoric coming out of the Fed, with a 0% federal funds rate, they would have to raise interest rates by over 700 basis points. Call it 750 to 7.5%, just to eke out a little bit of return, real return, over an inflationary environment that is robbing away the coupon value of the bond. So when they talk about raising bond prices to 2%, what is that? Anyway, all it will really do is throw us into a recession or worse. A 1% rise in interest rates often correlates to a 10% decrease in real estate prices. So all the people that bought real estate over the last few years at high points will be facing negative equity of 20% minimum, if indeed they do reach that 2% rate. But that 2% rate factored against inflation in excess of 7% is still real negative 5%. It's nothing. It doesn't affect anything. And really, I think what you're talking about is the Federal Reserve will most likely do what all administrations have done before it, including this one, and that is choose the printing press over austerity or the tough decisions. Because if they do indeed raise rates, see, I think they're just trying to raise them enough so that when the shit hits the fan in the markets, they have something that they can do within their tool chest, and that would be to lower rates again. It doesn't bode well for the world reserve currency to go nominally negative, and that's what they would have to do right now to lower rates. So realizing that we are nowhere near out of the woods, in fact, we're deep immersed in it, I would say that they're trying to raise rates as quickly as possible so that they can reverse course when things really get nasty and start to taper, start to stimulate and accommodate and lower interest rates again. Because we are in between a rock and a hard place right now. You know the old saying, heads you lose, tails you lose. Either they defend the markets by keeping this accommodative stance and stimulating and inflating, or they blow it all up and defend the dollar. And I believe they will choose the sacrifice of the dollar long before they will the tough decisions that they should have done in 2008. Letting interest rates be set by the market rather than by the bankers, as an example, to find real price discovery in all of these overbloated assets. And they will choose those overbloated assets, I believe, over the dollar. And this is what you've seen for all of time, as politicians will choose inflation from coin clipping in the Roman era all the way up to massive money creation here, where 50% of every dollar ever created in the history of this country was done in the last 20 months. Politicians will always follow suit. What's the old saying? A leopard doesn't change its spots. So that would be my take on it. And I guess, in my opinion, you ain't seen nothing yet. Hyperinflationary stagflation, who knows? That's kind of what I think we're going to see, which would be massive rise in prices as you see continued inflation, continued supply chain problems characterized by little or no economic growth, as the middle class and all of these mandates are being eviscerated. So it doesn't sound like a very optimistic appraisal, but we should have let Mother Nature have her 2 pounds of flesh in 2008. Now it's going to be a lot worse when it finally does try to find equilibrium. I think there's going to be a bumpy road ahead. And this is why you own precious metals, Elliot. You own it as wealth and to get out of harm's way.
Yeah, absolutely. I can see people starting to want to chase gold and silver as this price action kind of unfolds, because this is really interesting, just watching growth and tech stocks crash and gold and silver pump and oil pump. So where can people get ahead of this? You're the CEO of Miles Franklin. How can they get access and exposure to precious metals?
Yeah, well, we'd ask them to send us an email at info@milesfranklin with any questions. We'll send them a current inventory, which we update weekly. Certainly put the early stage investor in the subject line to make sure they're getting the best price, which we will promise. And we welcome any phone calls, any emails. We're all about relationships and answering questions, Elliot, and certainly happy to work with you and your listeners in any capacity. It's great to be here. I like our Wednesday conversations, and look forward to seeing you again next Wednesday.
Yeah, we'll stay on top of all.
Oh, wait, by the way, I forgot, I should mention, I need to send you our specials. And I don't know if I sent you last week's, but we're running the same special from last week in silver. We have the VALCAMBI kilo bar and the NADIR 10-ounce silver bar. And if I sent you those, post those again in the description. I think they're as good of a value in silver as you will ever find right now, in stock, ready to ship, and kilo silver bars from the VALCAMBI mint, 10-ounce silver bars from the NADIR mint in stock, really well priced, especially in relation to the higher priced silver coins that we're seeing right now as the sovereign mints struggle to keep up with demand.
This discussion is for informational purposes only. Nothing in this discussion should be taken as investment advice. Guests are not compensated for their appearance. Do not base any investment decisions on the information presented.